The median home in America now costs about 5 times what the median household earns in a year. In the 1980s, that number was closer to 3. You did not imagine it getting harder. It actually did. Most people assume prices went up because of supply and demand. Too many buyers, not enough houses. That is only part of the story. The bigger reason rarely gets mentioned, and it has nothing to do with construction or population. So if it is not just supply and demand, what is actually pushing the price of your next house up? The answer traces back to something most Americans were never taught about how banks work, and by the end of this video, you will understand it completely. Until then, every year you wait to buy is a year the same invisible force keeps working against you. My name is Alex. Maybe you pay your bills on time. Maybe you save every month like you're supposed to. And you still feel like the math is working against you. If that sounds familiar, keep watching. The problem was never your effort. I'm going to show you how your bank creates the money for your mortgage the moment you sign the papers, and why that same bank can approve you for a boat loan faster than a small business loan. Once you understand how this system actually works, you will stop reading your loan documents like a customer and start reading them like someone who knows what is really happening. There is not just one kind of money sitting in your bank account. 3 types of money explained. Open your banking app right now and look at the number on the screen. That figure isn't sitting anywhere. It's not stacked in a vault, not printed on paper somewhere with your name on it. It's a line of code on a server, and yet you trust it enough to pay your mortgage with it, argue about it, and lose sleep over it. Worth asking why, honestly. Here's the part almost nobody gets taught in school. There is not one kind of money in America. There are 3, and they behave completely differently from each other. The first kind is central bank reserves. This is money that only exists between banks. You cannot hold it, spend it, or even see it. It lives inside the Federal Reserve System, and banks use it to settle payments with each other behind the scenes. You will never touch this money directly in your life. The second kind is cash, the paper bills and coins you might still carry. The Federal Reserve prints this, and it's the version most people picture when they hear the word money. But here's the surprise. Currency in circulation across the entire country adds up to a little over $2 trillion. The total supply of spendable money in the U.S. economy, tracked by the Fed as M2, currently sits above $22 trillion. Do the math in cash is less than 10% of it. Everything else, more than 90%, exists only as numbers on a screen. That brings us to the third kind, and it's the one that actually runs your financial life. It's called commercial bank money. That's a formal way of saying it's money a private bank typed into an account. Take Dana Kowalski, a pharmacist in Tampa, Florida. When her mortgage got funded, when her car loan came through, when her paycheck lands every other Friday, none of it arrived as printed cash. A bank somewhere credited an account. That's the entire transaction. So sit with that ratio for a second. Government printed cash makes up less than 10% of the money in this country. Bank-created digital entries make up the rest. If you assumed the government controls the money supply, you assumed wrong, and you're not alone in that. Most people do. This matters because it changes the question you should be asking. It's not how much money the government prints. It's how private banks decide to create the other 90% and who they create it for. Because every time someone gets approved for a loan, whether it's a family buying a house in Columbus or a guy financing a new Ford F-150 at the dealership down the street, new money gets created in that exact moment. Not moved, not transferred from someone else's savings account. Created. And here's where most people get the story backward. The common belief is that banks take deposits from savers like Dana, hold a chunk in reserve, and lend out the rest to borrowers. It sounds logical. It's taught in textbooks. It's also not how it works anymore. And once you see why, a lot of what feels confusing about credit, mortgages, and interest rates starts making a lot more sense. Why banks don't need deposits. Picture the ideal customer for a bank, at least according to the story most of us were told growing up. A saver, someone who parks their paycheck and lets it sit. That customer should be treated like gold, right? So why does the average savings account in this country currently pay about 0.38%, while some of the biggest banks in America pay a flat 0.01%? That's 10 cents a year on every $1,000 you hand them. Here's the belief most of us grew up with. You put your paycheck in the bank holds 10% of it in reserve, just in case. Then it lends out the other 90% to someone buying a house or a car, and it earns interest doing it. Your deposit is the fuel. That's the whole system, right? Except that story stopped being true years ago. And honestly, it might never have worked exactly that way to begin with. Back in March of 2020, the Federal Reserve dropped the reserve requirement for every bank in the country to 0%, not 10%. Zero. It's still zero today. Banks are not required to hold back a single dollar of your deposit before lending it out. Legally, they could lend against money that isn't even sitting there. Take Renata Ford, an ER nurse in Charlotte, North Carolina. She's got $91,000 sitting in her Chase savings account, built up over 6 years of discipline. Last year, that balance earned her $9.10. Meanwhile, the same bank approved a stranger for an $800,000 mortgage in under 2 weeks. If Renata's money were actually fueling that loan, wouldn't Chase be paying her a little more to keep it there? It wouldn't, and it doesn't have to, because it isn't relying on her deposit at all. That's exactly why the rate gap exists. Compare that same Chase account to an online bank with no branches and no marble lobbies. Plenty of them are currently paying close to 4% on the identical kind of account. Same FDIC insurance, same safety. Roughly 400 times the return. The difference comes down to need. Smaller digital banks actually do rely on deposits to fund their balance sheets. The giant national banks don't. They can create the money they lend directly the moment they approve a loan without touching what's sitting in your account at all. Let that sink in for a second. The bank holding your money isn't fighting for it, isn't rewarding you for keeping it there, and doesn't need it to say yes to the next customer. That's not a conspiracy. It's just what a zero reserve requirement makes possible. So if your deposit isn't the source of the loan money, something else has to be. And it's not sitting in a vault somewhere either. When a bank approves you, or someone shopping for a Ford Bronco Raptor at the dealership, or a family closing on a house, the money for that loan doesn't come from another customer's account, and it doesn't come from a stack of cash in the back room. It comes from somewhere far simpler than most people expect. And honestly, once you see it, you'll wonder why nobody explained it to you sooner. How banks create mortgage loans. 11 signatures. That's roughly how many times you sign your name at a typical mortgage closing table before you're handed the keys. And at some point during all that paperwork, it's worth asking a basic question nobody stops to answer in the room. Where does the actual money come from? Because nobody wheels in a cart of cash. Nobody transfers it from another customer's account while you watch. So what's actually happening? Take Derek Alvarez and his wife, Monica, both teachers, who bought a 3-bedroom house in the Clintonville neighborhood of Columbus, Ohio for $427,300, right around the national median home price this year. They put down 20%, $85,460, and financed the rest through a Huntington Bank branch downtown. Their loan came out to $341,840 at 6.76%, the going rate for a 30-year fixed mortgage right now. Their monthly payment lands at $2,220. Here's how that loan actually got created, and it comes down to something called double-entry bookkeeping. Every bank keeps 2 columns. One side lists what the bank owns, the other lists what the bank owes. Every single transaction has to show up on both sides at once, or the books don't balance. So when Huntington approved Derek and Monica's loan, 2 things happened in the exact same instant. On one side, the bank wrote down that the Alvarez family now owes $341,840 plus interest over the next 30 years. That's an asset for the bank, a future stream of payments it now owns. On the other side, the bank wrote down that it now owes the seller of the house that same amount, since that's where the loan proceeds actually flowed. Both entries appeared at once. Nothing was moved from another account. Nothing was pulled out of a vault. The bank typed both sides into existence, and the books balanced instantly. Remember that banks aren't required to hold any of your deposits in reserve before lending. This is exactly why that rule matters here. There was no pot of saved-up cash Huntington was drawing from to fund this mortgage. The only real limit was whether their underwriters believed Derek and Monica were creditworthy enough to repay it. Once they said yes, the money simply appeared. Don't take my word for it either. Educational material published by the Federal Reserve Bank of St. Louis walks through this same mechanism directly. When a bank makes a loan, it creates a new deposit in the borrower's account, and that new deposit counts as new money entering the economy. straight from the people who actually run the system. So over the next 30 years, Derek and Monica will send Huntington that $2,220 payment every single month. By the time the loan is paid off, they'll have sent the bank $799,150 total, more than $457,000 of it in interest alone, more than the entire loan they started with. Now here's where it gets strange. Only one piece of that $799,000 sticks around permanently. The rest disappears the same way it showed up. Principal disappears. Interest is profit. There's a version of this you've probably lived through without realizing it. Ever lease a car? You drive it for a few years, make your payments, and at the end, you hand back the keys, and it's just gone. Not destroyed exactly, but gone from your life the same way it arrived. Beverly Sanchez knows that feeling well. She leases a Chevrolet Corvette Stingray from a dealership outside Austin, Texas, and every month for 3 years she writes a check for it. The only thing that stayed real the entire time was the money she paid. Here's a thought experiment that isn't a perfect legal match, but it captures the mechanics almost exactly. Imagine a bank that doesn't rent you a car. It rents you an imaginary one. The car doesn't exist until the moment you sign the lease. Then, for years, you drive it around and pay real monthly rent on it. And on the day you make your final payment, the imaginary car vanishes, exactly the way it appeared. Now swap that imaginary car for a standard bank loan, and you've got the real mechanism. Remember the $341,840 that Huntington typed into existence for Derek and Monica's mortgage back in Columbus? That loan has 2 separate parts, and most people only ever think about one of them. The first part is the principal, the original $341,840. The second part is the interest, the extra amount charged for borrowing it, which on their loan adds up to more than $457,000 over 30 years. When Derek and Monica make a payment, here's what actually happens to each piece. The portion that goes toward principal doesn't get handed to another customer, and it doesn't get locked in a vault somewhere either. It simply gets deleted. The same system that typed that money into existence now erases it, dollar for dollar, as it comes back in. $341,840 real dollars, created out of nothing, eventually returns to nothing. But the interest is different. The interest is the part the bank actually keeps. It doesn't vanish. It becomes profit, revenue the bank uses to pay its own expenses, its shareholders, its next round of branch renovations. So over the life of that mortgage, the bank isn't really profiting off the house itself. It's profiting off the price of temporary access to money it created for free. Sit with that for a second, because it changes how a mortgage actually looks. It's almost like the bank leased Derek and Monica an imaginary Corvette Stingray and collected 30 years of very real rent on it. The car was never actually theirs to lend. The rent absolutely was real, every single payment. And this raises an uncomfortable question. If the bank's only real cost is administrative, and the loan itself costs nothing to create, why does a mortgage carry 6.76% interest instead of something closer to zero? Some of that is genuine risk, since people do default. But a chunk of it is simply because the bank can charge it, and borrowers, understandably desperate for a house in a market where prices keep climbing, agree to the terms. Which brings up something more interesting than the interest rate itself. If the bank's real constraint isn't a shortage of money, since it can create as much as it wants for a creditworthy borrower, then the only thing actually limiting how much gets lent and where it goes is a decision, a choice about who gets approved and who doesn't. Mortgage lending versus small business loans. Ask any small business owner in America the same question, and you'll get almost the exact same answer. It's easier to borrow $400,000 for a house than it is to borrow $50,000 for the business that pays your mortgage in the first place. That's not a complaint. That's just how the numbers currently shake out, and it's worth understanding why before you assume it's about you. Gary Whitfield runs Whitfield Heating and Air, a small HVAC company in Dayton, Ohio. This spring, he needed $50,000 for 2 new service trucks and to bring on an apprentice because business was picking up and he was turning down jobs. He walked into his bank, filled out the paperwork, handed over 2 years of tax returns, and waited. And waited. 6 weeks later, he got a no. That same month, the exact same bank approved him for a $411,000 a $75,000 home equity line of credit in about 9 days. Same guy. Same income, same bank. The numbers back up what Gary experienced, and they're not close. Big national banks currently approve somewhere around 13 to 15% of small business loan applications they receive, according to the Biz 2 Credit Small Business Lending Index. Even with the extra backing of an SBA guarantee, large banks fully approve less than half of applicants, while small community banks and credit unions fully approve somewhere in the mid-50% range, according to the Federal Reserve's own Small Business Credit Survey. If Gary had walked into a community bank instead, the math would have been in his favor. Instead, he walked into a big bank, and the math worked against him before he even sat down. Meanwhile, that home equity line came through almost automatically. Gary used it to pay off his old roof, renovate a lake cottage he and his wife own near Traverse City, Michigan, and buy a Sea Ray SLX 400 outboard for weekends on the water. None of that builds his company. None of it hires anyone. And the bank didn't blink. Here's why the bank behaves this way. And it's not personal, and it's not because loan officers dislike small business owners. It comes down to risk. If Gary's HVAC business hits a rough stretch and he can't make payments, the bank's collateral is Gary's promise, and whatever equipment he's financed, both of which can lose value fast. If Gary stops paying on the home equity line, the bank has an actual house behind it, sitting on land, in a market where prices have historically gone up more often than down. One of these loans is backed by something the bank can seize and resell with relative confidence. The other one isn't. Now stretch that same logic across the entire country. Because Gary's story isn't unusual, it's the pattern. Roughly 2 out of every 3 jobs in the U.S. economy come from small businesses, and yet the money that gets created by the banking system consistently favors people who already own property over people trying to build something new. It's not because bankers are villains sitting in a back room plotting against entrepreneurs. Most of them are just people doing their jobs inside a system that rewards one kind of lending over another. The incentive isn't complicated. It's just quietly, structurally lopsided. So think about what this actually does at scale. Every year, trillions of dollars in newly created bank money flow overwhelmingly into real estate, the safest bet on the bank's books, while the businesses that would actually create jobs and new income get a fraction of that same appetite. Multiply Gary's experience by millions of small business owners across the country, and you start to see a pattern that shows up somewhere much bigger than any one person's bank statement. It shows up in the price of the house down the street from you, housing prices, debt, and the fix. Here's a question worth sitting with for a second. If a type of lender exists that's actually willing to fund small businesses like Gary's, why isn't it the first place anyone thinks to go? Because that lender does exist, and most Americans have never even heard its name. Patricia Ningyan wanted to open a second location for her bakery in Fresno, California. 2 big banks turned her down in the same month. Then she walked into a community development financial institution, a CDFI, and walked out 3 weeks later with the loan. Same business plan, same financials, completely different outcome. Before we get to why that gap exists, let's zoom all the way out, because Gary's denial and Patricia's approval aren't isolated stories. They're symptoms of something showing up in your monthly budget, whether you've noticed it or not. Total household debt in America currently sits at $18.8 trillion, according to the New York Federal Reserve. Mortgage debt alone makes up $13.2 trillion of that, roughly 70% of everything American households owe combined. That's not an accident. That's what happens when a banking system consistently funnels newly created money toward real estate over almost everything else. And here's what all that mortgage money actually does once it enters the system. It doesn't build new houses. It chases the same limited supply of existing ones. More dollars, same number of homes. And you already know what happens to price when that occurs. The median home in America now costs about 5 times what the median household earns in a year. Financial planners have long considered a ratio of around 2.5 to 3 times income to be genuinely affordable. We're nearly double that, nationally, right now. Your parents likely bought their first house on one income. You're finding out the hard way why that math no longer works the same way for you. So is the answer to stop banks from creating money? Not exactly, and this is the part that surprised me too. The problem was never that money gets created out of nothing. It's which direction it flows once it's created. Picture two identical $1 million loans. One goes toward buying an existing house that already had an owner. Nothing new gets built, nobody gets hired, and the price of every similar home nearby ticks up a little. The other $1 million goes to a small business owner who uses it to lease a building, buy equipment, and hire 10 people. Same banking system, same mechanism, completely different outcome for the actual economy. This is exactly why CDFIs exist. And honestly, more Americans should know their name. The US Treasury has certified over 1,400 of them nationwide, and together they've deployed more than $30 billion into small businesses and communities that big national banks routinely pass over. Patricia's Bakery is proof the lopsided lending pattern isn't some unavoidable law of banking. It's a choice big institutions keep making, and it's a choice smaller, local lenders keep making differently, with real results to show for it. None of this means the system is rigged against you personally, and it definitely doesn't mean the game is unwinnable. It means the rules were never really explained, and once you can see them clearly, a mortgage stops looking like a mystery and starts looking like exactly what it is: a tool built by a system with its own incentives that you can now use with your eyes open instead of your eyes closed. The money was never the mystery. The direction was. An hour ago, your mortgage probably felt like something that just happened to you. Now you know it's something that happened by design. Banks don't lend out your savings. They create money the moment they approve you, erase it the moment you pay it back, and keep the interest as the toll for renting it. That's not a conspiracy. It's an incentive. And incentives explain almost everything money does that used to feel confusing. A few things worth carrying with you. Money gets created by decision, not by a printing press. Reserve requirements haven't limited lending in years. Banks favor collateral over creation, which is why your house gets funded faster than your business idea ever will. And the direction that money flows, not the fact that it's created, is what actually shapes the price of everything around you. Next time you see a headline about home prices, or a friend gets turned down for a business loan, you'll recognize exactly what's happening underneath it. That's not a small thing to carry into every financial decision from here on out. If this reframes something for you, pass it along to someone still wondering why the math stopped adding up.